For most of modern history, people believed something very simple. If you worked hard, if you saved consistently, if you delayed gratification, you would be safe. Not rich, not powerful, but safe. That belief didn't come from nowhere. It was taught, reinforced, protected. Because for a brief window in history, it was true. After World War II, governments needed stability. They needed obedience. They needed long-term planning from their populations. So they made saving money feel responsible. In the United States, savings accounts paid real interest. In the 1950s and 1960s, the average savings rate hovered around 5 to 6%. Inflation was lower, wages were rising, debt was limited, and most importantly, money was still constrained. The dollar was still tied indirectly to gold. Governments could not print freely. Deficits had limits. Savings represented stored labor, stored time, stored power. But that system had a problem. Saved money limits governments. When citizens save real value, governments lose flexibility. They lose control. They lose leverage. And eventually they lose power. So in 1971, something quietly changed everything. On August 15th, 1971, U.S. President Richard Nixon suspended the convertibility of the dollar into gold. There was no vote, no public debate, no emergency broadcast, just a Sunday night announcement. From that moment forward, money was no longer anchored to anything physical. For the first time in modern history, governments could create currency without restraint, and that single decision made long-term savings dangerous, not for citizens, but for the system. Because when money can be created endlessly, savings become an obstacle. Every dollar you save is a dollar not circulating, not taxed, not inflating away existing debt. So governments didn't ban saving. They did something much smarter. They made saving useless. In the 1970s, inflation quietly began eroding purchasing power. Savings accounts paid less than inflation, year after year. People were told this was temporary, a cycle, a phase. It wasn't. From 1971 to today, the US dollar has lost over 85% of its purchasing power. Not because of war, not because of collapse, but because of design. And this pattern is not American. It is universal. In Weimar Germany in the early 1920s, citizens saved faithfully. Teachers, engineers, shop owners. They did everything right. Then the government printed to cover war reparations. By 1923, life savings couldn't buy bread. People burned money for heat because it was cheaper than firewood. Savings didn't fail suddenly. They died slowly, and all at once. In Argentina, the same pattern repeated multiple times. In 2001, after years of government mismanagement and currency controls, bank accounts were frozen overnight. People woke up to find their savings inaccessible, not gone, just unreachable. The government called it temporary. It lasted months. Savings were converted forcibly into devalued pesos, legally, peacefully, systematically. In Cyprus, in 2013, depositors learned a new word, bail-in. Banks didn't fail. Depositors paid. Savings above a certain threshold were confiscated to stabilize the system. Again, legal, again, framed as necessary. These are not accidents. They are rehearsals. Because the modern financial system depends on one thing above all else. Continuous movement of money. Savings stop movement. Savings slow velocity. Savings expose inflation. So governments don't want citizens saving. They want citizens spending, borrowing, investing in approved assets, holding money inside systems they can monitor, tax, and adjust. This is why interest rates stayed near zero for over a decade after 2008, not to help savers, to punish them. Zero interest rate policy wasn't a mistake. It was a message. If you save, you lose. If you speculate, you survive. And if you question the system, you're told to be patient. But here's the part most people miss. Governments don't just tolerate inflation, they require it. Because inflation silently transfers wealth, from savers to debtors, from workers to institutions. Every year inflation runs above interest rates. Savings shrink without confiscation. No headlines, no outrage, just math. And now, with digital money, that control becomes absolute. In the past, people could withdraw cash, hide value, exit quietly. Today, that escape is closing. Cash limits, transaction monitoring, capital controls. Not because governments hate freedom, because freedom interferes with debt-based systems. And this is why governments will never let you save real money again, not openly, not honestly. They will encourage saving, but only inside systems they control. Retirement accounts locked until old age, bank accounts exposed to inflation, assets taxed, tracked, and regulated. Saving still exists in name, but not in power. And once you see this pattern, historically, repeatedly, globally, you realize something uncomfortable. The system isn't broken, it's functioning exactly as intended. For a while, governments didn't try to destroy savings directly. They redirected them. They realized something after the chaos of the 1930s and the inflation of the 1970s. People will accept losing control over their money if you convince them it's for their own protection. That's when personal savings quietly gave way to managed savings. Before World War II, most people saved directly: cash, gold, land, private assets. After World War II, saving was institutionalized. Pensions replaced personal responsibility. Retirement accounts replaced cash reserves. Insurance replaced independence. At first, this looked like progress. In the United States, corporate pensions exploded in the 1950s and 1960s. Workers were promised lifelong income in exchange for loyalty and stability. But pensions came with a catch. You didn't control the money. You couldn't access it. You couldn't move it. And when inflation rose in the 1970s, pensions quietly collapsed. Companies couldn't afford the promises they made. Governments didn't want the liability. So pensions were replaced with something new: defined contribution plans, 401ks, IRAs, retirement accounts that shifted risk from institutions to individuals. On paper, you were saving. In reality, your money was now trapped inside markets you didn't control, governed by rules that could change at any time. Withdraw early, penalty; move capital freely, restricted. Hold cash instead. Inflation erodes it. And most importantly, these accounts forced participation in financial markets that require constant liquidity to survive. Your savings became fuel. This wasn't accidental. After the collapse of Bretton Woods, governments needed a way to absorb excess money creation without causing visible inflation. So they engineered asset inflation instead. Stocks, bonds, real estate. Savings were no longer meant to sit still. They were meant to be invested, meaning exposed to risk, volatility, and policy shifts. If markets fall, your savings fall. If interest rates rise, your savings fall. If governments intervene, your savings adjust, always downward. This pattern repeats everywhere. In Japan, after the asset bubble burst in the early 1990s, interest rates were cut to zero and stayed there for decades. Japanese savers were punished year after year. Cash earned nothing. Bonds yielded nothing. Inflation quietly ate purchasing power. Why? Because Japan's government debt exploded, and debt cannot coexist with real savings. One must destroy the other. In Europe, negative interest rates made the message explicit. You were charged for holding money in the bank. Saving became a liability, and yet people accepted it because alternatives were systematically closed. Capital controls, tax penalties, regulatory pressure. The illusion of choice remained. The reality did not. And now we've entered the final phase: digital money. Central bank digital currencies are not about efficiency. They are about programmability. They allow governments to decide how long money can be saved, where it can be spent, what it can be used for, when it expires. This isn't science fiction. In China, digital yuan trials already include expiration dates on money to force spending. In 2020, stimulus payments in multiple countries were designed to expire if not used quickly. Savings were treated as sabotage, because when systems are overloaded with debt, saving becomes defiance. This is why every modern solution attacks savings indirectly. Inflation instead of confiscation, fees instead of seizures, regulation instead of bans. And every crisis accelerates the process. After 2008, interest rates went to zero. After COVID, money creation exploded. After inflation returned, rates rose, but never enough to protect savers. Because protecting savers would break governments. Debt-based systems survive by eroding stored value. That's not opinion, that's arithmetic. And this is why governments will never let you save real money again. Not because they hate you, but because your savings represent independence. And independence is incompatible with systems built on perpetual debt. For a long time, people believed the solution was simple. If savings stopped working, you just needed to save more. Work harder, delay longer, be more disciplined. History shows this instinct is exactly what systems rely on, because when people keep saving inside a broken framework, the framework survives longer. This is why the final phase of every debt-based system looks the same. Trust slowly erodes. Not all at once. Not loudly. People don't panic immediately. They adapt. They accept lower returns. They accept higher prices. They accept temporary measures that never reverse. Until one day, they realize that something fundamental has changed. Saving no longer feels protective. It feels pointless. And that moment has happened before, many times. In late Roman society, citizens stopped saving in coin. They hoarded goods instead: land, food, tools. Money still existed, but trust in it collapsed. The Roman state responded with price controls, labor restrictions, and legal penalties for non-compliance. Saving privately became illegal in practice. Not because Rome hated savers, but because Rome needed control. In France, before the Revolution, people stopped trusting state finances. They rushed into land and physical assets. The government responded with new taxes, forced loans, and currency manipulation. Eventually, the system snapped. In Germany in the early 1920s, once people realized savings were doomed, behavior changed overnight. Workers spent paychecks immediately, businesses stopped pricing in currency, barter replaced money. The state lost control not because money disappeared, but because belief did. That is the moment every system fears most. Because systems can survive inflation, they can survive debt, they cannot survive disbelief. This is why modern governments are obsessed with narrative. They don't need you to believe money is strong. They need you to believe it is necessary, that there is no alternative, that saving differently is dangerous, irresponsible, or illegal, that independence is risky, that compliance is safety. This is why financial education is shallow. This is why real history is rarely taught. This is why discussions about money are framed as technical, boring, or too complex. Because once people understand the pattern, they stop playing the role assigned to them. And that role has always been the same. Save. Wait. Absorb the cost. Historically, those who escape this cycle are not geniuses. They don't time markets perfectly. They simply understand that systems always protect themselves first. They watch for the same signs every time. Interest rates below inflation, debt that can never be repaid, rules that change quietly, controls that tighten slowly. And when those signs appear, they don't argue. They don't protest. They reposition. This isn't about fear. It's about literacy. Understanding that saving real money in a debt-based system is not encouraged. It is tolerated only when the system can afford it. And once it can't, saving becomes the problem that needs to be solved. This is why governments will never let you save real money again. Not openly, not honestly. They will let you think you're saving. Inside accounts you don't control. Under rules that can change. At rates that never protect purchasing power. Because a population with real savings can say no. And systems built on debt cannot tolerate no. If this feels uncomfortable, that's the point. History isn't comforting, it's revealing. And the people who understand it early don't need panic, predictions, or promises. They need clarity. If you want to keep seeing how these systems actually work, not how they remarketed, subscribe. Not because collapse is guaranteed, but because understanding the rules of the game is the only advantage people have ever had when the rules change